What is going on, ladies and gentlemen? Today we're going to be talking about delta, one of the 5 options Greeks. We've already talked about theta in the last video, so be sure to go check that out. And what the delta basically is when the stock moves $1, it's the price that your options contract is going to move up from the dollar move that the stock is making. So let's get right into an example just so you guys can have a visual representation of what I mean. And I know I've said in almost every single video that when a stock moves past your break even, it's $100 every dollar the stock moves. But in reality, it's actually the delta that produces that price of when a stock moves $1, how much the options contract actually changes in value. But just like theta, this is just if the stock stayed consistent and moved $1 consistently. But as you get closer to in the money, the delta rises. And that's just the assumption of every time a dollar move happens past your break even, the options contract moves $1 with the stock. Because once you get in the money, the delta really starts ramping up. As you can see, when you go to the 315 one, the delta is 70 cents. You go to the 312.5, 78 cents, and it just gets more and more as you get in. And that whole theory, I always keep saying, it's basically irrelevant. It's just for new people so they have kind of an idea of what a stock can do as it's moving and why you would want such a low break even. Because once you find out delta, you slowly start to understand when you buy slow-moving stocks or ones maybe not like Apple that have smaller spreads, maybe like Walmart that have dollar spreads in between, or like AMD or Intel that have 50-cent spreads in between. Those contracts aren't going to gain as much value as quick as these stocks. So you always want to keep that in mind. So say, for example, we bought this 327.5 call for 55 cents. The delta on this right now is 14 cents. So every time Apple moves up $1, this contract's going to gain 14 cents. So by the time it gets to where this 320 contract is and it's at the money, it's going to be gaining about 50 cents per dollar. And then once it gets in the money, you can see it doubles almost. And this is just kind of assumption of how this stock would move if you bought it, but you could always come back to your contract and look at the delta and watch it rise as it gets closer to being in the money. And then once you're in the money quite a few dollars, it's going to start ramping up even more quickly. And of course, as you get closer to the expiration date, the delta is going to change as well. So you can really see how delta and theta work with and against each other, and it can kind of help you pick out a contract between all of these. And we could go look at a later dated contract, check out this 327 again. This one gains $36 every time Apple moves $1, so that's almost double, but you have way more time. So you can see how time helps you because you don't have as much theta, you have more delta, so the time is definitely beneficial when you're buying these contracts, but they're just more expensive, of course. But as you can see, once you get in the money, it really doesn't change as much. We can look at this 315, 60 cents per dollar. We go to the February 14th. This one's even more. So in inverse, when you have less time and you're in the money, your contracts are gaining more value because that's why these contracts are valuable, is because when they go in the money, you're able to buy or sell the shares depending if you have a call or a put. So the delta can be a little confusing, but just keep it simple. When it's out of the money, you're going to get less delta. When it's in the money, you're going to get more delta. When you have more time and it's out of the money, you're going to get more delta. But it doesn't really change the value too much once you're in the money. Once you're in the money, the contracts are going to start moving at a normal rate, which is kind of where the $100 per dollar comes from on every stock, because of course you have the time value as well, so that adds in, and the volatility, all that. But that's just a made up thing just to keep it very simple for people. So now you know a little more about options Greeks. We got 3 more to cover. We got to cover gamma, vega, and rho, but delta and theta are definitely the most important ones. So be sure to watch this video a couple times. Be sure to go check out the theta video because that one's even more important than this, I would say. But hey, even I learned a little bit about delta. I really didn't know that time didn't give you more value when they were in the money, so that's something new for me. But I hope you guys enjoyed this video. Be sure to leave a like on the video. Be sure to subscribe to the channel. Be sure to check us out live. We're live Monday through Friday, market open to market close. And I'll see you guys in the next video.